Welcome to another tutorial video. As you can see, we're going to be going into a somewhat different topic this time around and talking about oil and gas modeling and specifically the concept of the type curve or type curves. Now, the reason why we're going into this is because we used to have an oil and gas modeling course. We discontinued it back in 2021, a couple years ago, but earlier this year we brought it back, and just last week we actually replaced it with a new version that covers all three major verticals: upstream, midstream, and downstream financial modeling within oil and gas. And so this lesson is a bit of an excerpt from that new version of the course. So for all the files and resources here, you'll want to go to our oil and gas modeling page on the knowledge base and go to type curve oil and gas. I'll pin this comment below the video so you can click through to it there. As always, it'll be the first comment. So let's talk about type curves in oil and gas modeling. I will start with the summary and then I will go into the full details and go through the Excel formulas and show you some of the model setup as always. The type curve shows you the initial production from a well in a specific region and how that production declines over time, and you use it in models to estimate the revenue and expenses and capex for the well. So let's look at an example right here. This is from this company Silverbow Resources. They have a type curve right here and they show you the daily production over roughly the first 3 months, the first 90 days, and then they show you how that daily production declines over the first 24 months. And then they give all these other parameters here, such as the target DNC, the NPV10, the EUR or estimated ultimate recovery, and they list a lot of other variables and assumptions right here. So this is a real world example of a type curve. In oil and gas, you normally go down to the asset level to model the individual wells that a company drills, and then you aggregate the cash flows with functions such as offset to create a bit of a roll-up summary that has the cash flows from all the different sources in one spot. So the type curve is a critical component of an exploration and production company's future growth or future cash flows from the wells that it is not yet drilled but plans to drill in the future. In real life, it is often quite difficult to use type curves and the accompanying formulas and equations because companies often list only partial or incomplete information in their filings. The other issue is that type curves are not that useful for the company's production that comes from their existing operational wells, which are known as proved, developed, producing, or PDP wells. And in most cases, those account for the majority of an E&P company's implied value. I do have a very simple Excel model here for a type curve that shows some of the formulas and equations and then also goes into the revenue, expenses, and cash flow. And then I'll be showing you some excerpts and examples from our full net asset value model for this company Range Resources in the full oil and gas modeling course. So I'm going to start with some key vocabulary for type curves. Then we will go through this section on how to move from a type curve into a financial model and a cash flow projection for the company. And then we'll look at some real life problems with type curves and I'll explain why they may not be quite as useful as a lot of academic sources and courses and books would suggest. So what is a type curve? What is the key vocabulary here? I would refer you to this slide from Silverbow Resources because they list a lot of the key terms. In fact, almost all the key terms that you need to know right there, but let's go through them sequentially. So the D&C costs are the drilling and completion costs. This is the upfront capex that is required to drill a new well, and this varies very heavily by the region and well type. So you will see numbers all over the place here, ranging from millions to tens of millions to something in between. The EUR is the estimated ultimate recovery, and this represents the total oil, gas, and natural gas liquids the company can recover in an economically feasible way over the well's life. Now, a lot of people look at this and think that this is just the total amount of oil, gas, and natural gas liquids in the well, but that's not quite correct. The key point here is in an economically feasible way. So this could actually change as technology changes and as commodity prices change, because at higher prices, probably more in that well is going to be recoverable in an economically feasible way. The IP or IP rate is the initial production of the well when it first starts operating. This is typically measured in million cubic feet equivalent per day, or sometimes 1,000 cubic feet equivalent per day. It could also be measured in thousands of barrels of oil equivalent per day for oil dominant companies. If you look at the Silverbow Resources slide, the restricted rate right here is effectively the IP rate. They're listing it on a 30-day IP rate basis, although clearly this one extends to more like 90 days if you look at the actual graph. The B factor is something that is also mentioned on the slide. And this one is probably not immediately intuitive or obvious to you. Essentially, this measures the steepness of the production decline of the type curve. The counterintuitive part is that what it actually means depends a little bit on the shape of the curve, but for a hyperbolic decline curve like this one, higher numbers often mean a shallower decline after the initial period. But again, this varies a lot based on the shape of the curve and what some of the other variables and drivers actually are. The terminal decline is just the minimum decline rate the well will eventually reach. And this is important because even if you model a well with formulas for the hyperbolic decline in the production, for example, those formulas might predict a lower decline rate than this, but you have to cap it and limit it to this terminal decline rate. The LOE is the lease operating expense. This is essentially the fixed and variable expenses associated with production from the well. And then the NPV10 and IRR. So the NPV10 is just the net present value at a 10% discount rate, which is the industry standard. And then the IRR, you should already know, it's the annualized rate of return from the well. And in this case, the company has some very high numbers here. They have an NPV10 of 6.3 million and an IRR of 124%. So we'll see how our estimates stack up as we go through this process. If you want to actually project the production from a single well, one common formula is the hyperbolic decline formula right here. Now, we don't really have time to get into what every single component of this means, but the way you typically use this is to get the initial daily production from the company's information, and then you use this formula to forecast the daily production at the end of each year. So at the end of year 1, year 2, year 3, and so on. So let's go into Excel and take a look at how this works. I'm going to go over to the type curve tab over here. And so the company gave us the 90-day IP rate of 10 million cubic feet equivalent per day. They also give us the initial decline rate after that flat period of 60%, and they give us the B factor. So based on all that, I've entered the Excel formula right here. We can calculate the ending daily production in each period based on all these. So we'll start with 10 million for the initial production rate right here. And then we'll divide by 1 plus the B factor, which measures the steepness of the curve. We'll multiply by something called the D factor, which is essentially a natural log-based function that converts this into more of a continual decline rate. I'm simplifying this quite a lot, but that's the basic idea here. We multiply by the period number, and then we raise all of this to the power of 1 divided by the B factor right here. And I forgot a parentheses, but Excel fixed it. So let's copy and paste this formula all the way down so I can show you what this looks like. And so we have that. And so you can see the daily decline rate. And then I've also converted the figures to annual numbers right here. So we have the annual decline rate as well, at least past year 1. Now, one question you might have is, wait a minute, how are you getting the average annual production? Because if you think about it and you know something about math, you would know that the first 90 days is easy because this is just a rectangle. But then after this, technically, we should take an integral of this area to get the production over the 9-month period from month 3 to month 12 of year 1, and then from month 12 to month 24 in year 2. So technically we should be using calculus for this. I am simplifying it, and I'm not doing it the real way. I'm just using a simple numerical approximation here, and then after the first year, I'm just taking averages and then multiplying by 365 to get the annual production numbers. This is not really the ideal way to do it, but for a quick analysis or estimate like this, it's fine for our purposes. So that gives you an idea of what the shape of the production from a single well looks like. And of course, the next task is to move from this to an actual model or some type of cash flow projection. So as next steps, we need to limit the annual production based on the estimated ultimate recovery. We also need to limit the declines based on the terminal decline rate. So let's go back to Excel, to our very simple model, and go over to the well tab right here. You can see I've entered all the type curve assumptions up here at the top. And so I am going to start by going to period 1 and linking in our annual production for that period. Now for the decline rate, we want to limit this. So I am going to take the maximum between the annual decline rate right here and then the terminal decline rate right here, and we have that. So if we just copy and paste this formula down, I'll show you what this looks like. You can see that we hit a minimum of 5% right here, which contradicts what the formula tells us, because the formula tells us that this should keep going down to 2%, but the company is saying that actually the minimum is 5%. Now to factor in the estimated ultimate recovery, we're going to take the minimum between our previous annual production times 1 minus the decline rate right here. And then we're going to link to the estimated ultimate recovery, and then we're going to subtract our cumulative production from everything above so far. And this should limit us to the estimated ultimate recovery for the total cumulative production from this well. Let's add this up and see what it comes out to. And it is the 14.25 billion cubic feet equivalent that the company lists in its filing. So we have that. Now for the next step here, we need to get to the revenue. So we need to split the production into oil, gas, and natural gas liquids, and then assume a price for each one. Gas is priced based on $1 per 1,000 cubic foot equivalent, or $1 per 1,000 cubic foot basis. And then oil and natural gas liquids are priced on $1 per barrel of oil equivalent, or $1 per barrel basis. So let's take the production here and multiply by our gas percentage, which is 100%. And then for the natural gas liquids, we'll take this and multiply by the natural gas liquid percentage. We also need to convert here because we are dealing with million cubic feet equivalent, but we're trying to get to thousands of barrels. So we can divide by the conversion factor of 6. This is based on the energy content in oil versus natural gas liquids. Then we'll take this one and multiply by the oil percentage, and again, divide by that conversion factor of 6. And then we can copy this down. We have that, and let's do a summation for all of these. Now for the revenue, I have already entered some assumptions for the commodity prices here. I'm largely following what the company has done in its filings. So for these, we can take our gas production right here, multiply by the gas price. We're just assuming a constant price right here. We have a problem with the units because of the fact that this is in dollars per 1,000 cubic feet, but this is in million cubic feet. So we need to divide by 1,000 here to get these in the proper units. I have this named cell up here, units, so we can do it from right there. And then for the natural gas liquids, it is the same idea. Let's take this, multiply by the price, and then divide by units. And then for oil, same idea. Take this, multiply by the price, and then divide by the units right here. We can sum this up and then copy this down. So we have this, and I've copied this across. Now for the next part in this, we have the asset level expenses. The lease operating expense, fixed and variable components, and then transportation and processing expenses. Now you might be looking at this and wondering, wait a minute, that makes sense, but what about the corporate level expenses, such as paying for the employees, paying for the rent, paying for the corporate headquarters, the accounting, the IT, the HR services, things like that? And the answer is that in most oil and gas analyses, you do, of course, look at those, but you look at those separately. You tend to model the assets, the individual wells first, and then you think about everything else at the corporate level. So for these, for the fixed lease operating expense, so first off, we have to check that there's actual production right now. So we want to make sure this is not 0. And if that's the case, then we take the fixed lease operating expense right here. I'll divide by 1,000,000, so 1,000 times 1,000. I'll say 0 if we actually do not have any production right now. I'm doing this because this number was given to us in dollars per well per year, but we're listing everything in dollars and millions here, so we have a mismatch with the units and we need to correct for that. Now for the variable lease operating expense, we need to take the production right here and then multiply by our assumption right up here. We run into a problem with the units again, so I will divide by units. And then for the transportation, it is largely the same idea, except here, we're still linking to the production, but now I'm going to go one row below to get our transportation and processing right there. We can sum these up, and then we can copy these down. And I can sum up all of these to get our total expenses. This takes us to actually the last part where we calculate the cash operating income, the capex, and the cash flows. So this is pretty simple. We're just going to take revenue, subtract the asset level expenses, and then subtract the capex to get the cash flows. And in this case, the capex just consists of the D&C cost for this well. So for the capex right here, we're going to link to our D&C costs. I'm going to put a negative sign in front. They're saying 4.7 million. And then here for the cash operating income, we're just going to take our total revenue and subtract our total expenses. I linked to the wrong thing, so let me fix that. And then for the cash flow, we could do this in a couple ways, but I can just add these up for now. And then for the cash operating income, we can go down. And then the CapEx in each period after this is just going to be 0. So we'll set up the formula like that. And then we can copy everything here down. And then we can sum these up at the bottom, just as we're doing with everything else here. So we have that. We can see that our numbers do not really match theirs. We get an IRR of 113% and an NPV10 of 15 million. Their numbers are quite different. They're getting an NPV10 of 6.3 million and an IRR of 124%. So we're pretty close on the IRR, but the NPV is way off, most likely because we are assuming a different shape to the production curve here than what the company has. But this is the basic idea behind how you create a simple asset level forecast for a simple well based on the type curve. The next thing that you would do in real life is aggregate all the production and the cash flows from all the wells that are drilled each year. Here's an example. We have a production curve, and then we are essentially using a long offset function here to go to the appropriate year number and then bring in all the production from that. And we aggregate everything here and we add up everything to get our production at the bottom. And then later on in the model, we sum up the revenue and the asset level expenses from all of these and also the CapEx associated with drilling for these wells in the first place. Then after that, you create a roll-up schedule that summarizes the production and the cash flows by commodity type or by reserve type or well type or region or something like that. And you create this type of long cash flow projection, which for an oil and gas company can actually extend over several decades, if not even longer than that. The reason we like to do this is because for oil and gas, if you look at the output of such an analysis, the values of different types of reserves and wells and regions that a company operates in tends to be highly dependent on commodity prices, and it's really useful to see the impact of commodity prices. Obviously, these prices are going to affect everything, but they often have more of an effect on certain types of reserves and well types, and that's the whole purpose of separating it out like this. So that is the basic idea behind type curves and how you use them to move from the production in a company's filings to models and cash flows. I want to end by talking about some real-life problems with type curves. So the first problem is that most companies do not disclose all the information on a nice single slide format like Silverbow Resources did. Instead, you tend to see this type of schedule more often. And I'm going to pull up the investor presentation for Range Resources here. They do certainly give us some information about this. They give us the expected production levels for each year for different types of wells in one specific region they operate in. And they also give us the estimated ultimate recovery and the D&C costs. So this is all useful, but they're not giving us an equation. They're not giving us something that we can just plug into based on the B factor and the initial production rate and the decline rate in the first year and all that. So they're not really giving us enough information to go through the full analysis that I just showed you, and this is a very common issue. Another issue is that type curves are not that useful for existing producing wells because you don't know the age of every single well. Companies often have hundreds or thousands, and so you don't know the remaining resources in each well, you don't know where it is in the life cycle, and so it's very difficult to use it for that existing production. In a lot of cases, what this means is that you have to make very simple approximations. So for example, in this model, we have a decline rate for these existing wells of between 4 and 5%, which we just found via a goal-seek function in Excel. It sounds very simple and arguably even stupid, but the company just doesn't really give enough information to go too far beyond that. There are probably some smarter ways to do this. For example, we could have a percentage in each year that declines over time and then multiply by some type of constant, but you often have to make these very simple approximations due to the lack of information. And I just summarized what we did here, where this company has a reserve life of around 20 or so years, so we just assume that this production extends out for about 25 years in the analysis, and we set a decline rate that gets us something in that range. So that's about it. Let's do a recap and summary. What is a type curve? I showed you an example in the beginning. It spells out what the initial production from a company's well in a specific region is, and then how it declines over time. And ideally, it gives you factors like the B factor and the estimated ultimate recovery and the D&C costs and everything else you might use to move from that type curve, the production, to the revenue, the asset level expenses, and the CapEx and cash flows as I showed you. Ultimately, you want to use that to forecast the production from all the wells that the company drills and then to roll it up into the cash flows. In real life, companies rarely provide enough information to actually do this the full way that I just showed you, so you often have to make very simple approximations. Also in real life, it's difficult to use type curves with the existing wells that are already producing because you don't have all the details on all of them. They were all drilled at different times. They all have different decline rates. So you often just have to simplify and come up with some overall numbers as I showed you. That's it for this lesson. Hopefully now you know a little bit more about this very important concept in oil and gas modeling, how it works in real life, and why the theory is nice to know, but in a lot of cases, you cannot actually use all these formulas and equations to actually plot the production from a single oil and gas well.